The stock market crash of 2023. Are you prepared? Now, it's no secret that last year was a bad year for the markets. The S&P entered a bear market, dropping down 24% at its low. Now, the big question on everybody's mind is, are we headed for an even bigger crash, or is the worst already out of the way? Well, in this video, we'll be looking at three main things. The bear case of why a bigger crash is still to come. Then the bull case of why the bottom has already been reached. And then we'll finish with how do you position your portfolio so that no matter what happens, you can still make money either way. As always, if you do enjoy anything in the video, then drop a like, and a big thank you to everyone who does. Okay, first up, as per the title of this video, here are the reasons why a bigger crash is still to come. And the bear case begins with the elephant in the room of a recession that is looming. And ask yourself the question, during a recession, is it more likely that markets go up or down? And when we look at the landscape, we see that the biggest, most successful companies in the world are laying off staff. Microsoft to lay off 10,000 workers. We have Google laying off 12,000 workers. We have Amazon laying off 18,000 workers. So being objective, is this a red flag or a green flag? And this moves us nicely onto, and very topical today, the central bank and Jerome Powell. And I've talked about this before, but Jerome Powell has a dilemma. He has the inflation problem that he has to tackle, and he also has to make sure the stock market keeps going up. As whether investing directly or indirectly through pension plans, the only way the US population is going to retire is by stocks going up. And here's the problem that he faces. He has two main tools in his toolkit. He can raise and lower interest rates, and he can do QE or QT. And the problem is, lowering interest rates, meaning it's very cheap to borrow money, and printing money is excellent for the stock market. And this is what we've seen over the last few years, and you get a boom time. Problem is, when it goes too far, is that it creates inflation. And to tackle inflation, he needs to do the opposite. He has to raise interest rates and pull money out of the system. This, as we've seen, is now getting inflation under control, but it's also put us into a bear market. So it's a very delicate balance, and all eyes are watching the Fed. And what has the Fed been doing? They have been raising interest rates at one of the fastest times in history, outpacing all of these major rate hike cycles. And they're targeting around this 5% mark. Now, just remember this figure because it's going to be very important. The Fed's funds rate being at 5%. Because when we look at the Fed's funds rate, this is what it looks like going back to 1960. Now, the obvious thing in this chart was the massive rate hike to 20% to tackle high inflation at the beginning of 1980. But there's two more really important things to point out. Now, we know there was a major stock market crash in the year 2000, and we know there was a major stock market crash in 2007, 2008. So the question is, where was the Fed's funds rate at two of the biggest crashes in history? And check this out. At the absolute peak of the market before it started rolling over was here. And what was the Fed's funds rate? It was at 5.75%, very close to 5%. And in 2007, the peak of the market before it started crashing was here. And what was the Fed's funds rate? 4.28%. Again, very close to where we're at today. So the point is this: the stock market does not do well when interest rates are high. the stock market does very well when interest rates are very, very low. And if we listen to Dr. Michael J. Burry of The Big Short, he recently tweeted that he thinks we're probably around here right now. We're going through a bear market rally, and there's probably a bigger downturn to come. Now, the bull case is actually very simple. The bulls will say that US inflation is now under control. It has now fallen all the way down to currently 6.5%, the lowest level in more than a year, and the Fed has things under control. We have China that is now stopping their COVID policy and reopening, which could create a boom. The Fed's rate hike cycle is now pretty much over. And the markets are forward thinking, so it's already been priced in. Now, when it comes to investing, some people's portfolio might look like this, which would be 100% invested in the markets. And this could be all in stocks, it could be stocks and bonds, it could be crypto, but you could be 100% invested. Now, in a downturn, there's nothing you can do apart from take a big hit. But obviously, in a bull market, it's the best place to be. On the flip side, some people will be scared right now and either have or thinking about going 100% in cash. If the Fed does have things under control and we go into a bull market, this is the worst place to be. However, in a major crash, you would certainly be able to take full advantage. Now, I think in times like this is to look at the best investors in the world and see what they are doing. Well, here is Warren Buffett. And currently rounded up, his stock portfolio is worth around $300 billion and $100 billion in cash. So he is 75% invested and 25% in cash ready to deploy. And two things to notice. A key piece of his advice is to keep around 10% cash. So the fact that it's at 25%, he is certainly aware of things still being overvalued. And he has been living up to his famous quote, as this was over 30%, so he has been buying in the crash. But this is a great split of how you can win either way. So, as you saw, there is a very compelling case as to why a bigger crash is still to come. Yes, rate hikes may soon be stopping, but we're still left with very high interest rates. And one of the best ways for businesses to grow is to borrow money. And if that's difficult, then it's bad for stocks. We also saw that in two of the biggest stock market crashes in history, the Fed's fund rate was around 5%. And when we look at the landscape right now, the most successful companies are laying off staff. So that's also another red flag. Now, to finish up, another key message of this video is that markets have a very good way of doing the opposite of what people expect. So to finish with a good piece of guidance, you may want to be like Buffett and keep some cash ready to deploy. And that way you can win in either direction over the coming years. So there you are, guys. Hope you enjoyed. Now, unfortunately, as investors, we do have to go through the crashes as well as the boom times. So it's all part of the game. But for now, just to say, if you did enjoy anything in the video, then drop a like and a big thank you to everyone who does. And I'll see you in the next video. Bye for now.